Now, economy can also be impacted by credit inflation. So let's see how. While initially stimulating economic growth, excessive credit can lead to an unsustainable boom followed by a bust. It can create asset bubbles and financial instability if not managed properly. Now, we are moving toward our next topic, which is deflation. So, we will begin with the definition of deflation. Deflation is an economic phenomenon characterized by a general decline in the prices of goods and services. Unlike inflation, which refers to a rise in price, deflation signifies a decrease in the price level. This typically occurs when the inflation rate turns negative or falling below 0%. Now we will understand the mechanism of deflation. So deflation can be understood through various aspects. So we will dive into the first aspect, which is the price level decline. When deflation occurs, consumers can buy more goods and services with the same amount of money. This increase in the purchasing power of money means that the real value of money is rising. The second is impact on consumer behavior. With deflation, consumer might delay their purchases, expecting prices to drop further, which can lead to reduced spending and lower overall demand for goods and services, and thus creating a loop of decreasing in prices of the commodities. The third is its effect on debtors and creditors. Deflation can benefit creditors, those who lend money, because the real value of the money they are repaid increases. However, it negatively impacts debtors, those who borrow money, as the real value of their debt increases, making it more expensive to repay. So, this is all about the explanation of deflation. Deflation. Now, we will move toward the causes of deflation. So, the first is fall in aggregate demand. Aggregate demand represents the total demand for goods and services within an economy. When consumers and businesses reduce their spending, it leads to a drop in demand. This can be due to various reasons such as economic uncertainty, high level of debts, or a decline in consumer confidence. The second cause is fall in money supply. The money supply is the total amount of monetary assets available in an economy at a specific time. When the central bank or financial institutions reduce the money supply, there is less money available for consumers and businesses to spend. So, this reduction can occur through higher interest rates or other monetary policy tools aimed at reducing liquidity in the economy. The third is decline in confidence. Economic confidence is crucial for maintaining healthy spending levels. When consumers and businesses lose confidence in the economy, they tend to save more and spend less. This can be triggered by political instability, financial crisis, or other significant negative economic events. The next cause of deflation is increase in aggregate supply. Aggregate supply is the total supply of goods and services that firms in an economy plan to sell during a specific time period. An increase in aggregate supply without a corresponding increase in demand can lead to deflation. This can happen due to improved production techniques, availability of cheaper raw materials, or other factors that lowers production cost. Now we are moving to the another cause, which is lower production cost. Lower production cost can result from factors such as reduced price for raw materials, cheaper labor, or more efficient production processes. When production costs decrease, companies can afford to lower their prices, leading to deflation. The last cause of deflation is technological advances. Technological advancements often lead to more efficient production methods and innovations that lower the cost of goods and services. For example, automation and improved supply chain management can significantly reduce production costs, resulting in lower prices for consumers. Now we are moving toward the impacts of deflation. So the first is increased real debt burden. As prices fall during deflation, the value of money increases. This means that the amount of debt remains the same in nominal terms, but its real value, what it can buy in goods and services, rises. Therefore, borrowers have to pay back loans that are worth more in real terms than when they were borrowed. Now we will take example here to explain this. So let's assume if a business takes out a loan of 1000 crore and deflation occurs. The 1000 crore debt remains the same nominally. However, because the value of money has increased, the business must repay the loan with money that can now purchase more goods and services than when the loan was taken out, effectively increasing the debt burden. The second impact is reduced consumption. During periods of deflation, consumer may anticipate further declines in prices. This expectation can lead them to delay making purchases, hoping to buy goods and services at even lower prices in the future. Let's take an example. Suppose if consumers expect the price of electronics to drop, they might postpone buying a new laptop or smartphone or any electronic item. This behavior reduces current consumption, which can slow down economic activity and growth. The next impact of deflation is lower profit. Businesses may face declining revenues as prices fall. With reduced income, companies might struggle to cover their cost, leading to lower profitability. To maintain financial stability, they may need to implement cost cutting measures. For example, let's suppose a retail company experiencing deflation might see its sales revenues drop as prices fall. To cope with the reduced income, the company may reduce its workforce, cut back on investments, or find other ways to lower expenses, potentially leading to layoffs and reduced business activities. The another impact of deflation is increased unemployment. As demand for goods and services decreases, businesses may need to cut back on production. This often results in workforce reductions, leading to higher unemployment rates. Now, let's suppose, for example, a manufacturing firm facing decreased demand for its products may reduce its production levels. As a result, the firm may lay off workers, contributing to higher unemployment. Increased unemployment further reduces overall economic demand, creating a vicious cycle of unemployment and demand reduction. So, after looking at the impact and causes of deflation and learning about what deflation is, we can summarize it as deflation, while sometimes perceived as beneficial due to lower prices, can have significant negative effects on the economy by increasing the real burden of debt reducing consumer spending, the purchasing power, lowering business profits, and increasing unemployment. Deflation can lead to economic stagnation and create a challenging environment for both individuals and businesses. Policymakers must carefully monitor and address deflationary pressures to maintain economic stability and growth. Now we are heading toward the next topic, which is stagflation. Stagflation is an economic condition characterized by the simultaneous occurrence of three negative economic trends. And what are those economic trends? Let's see. The first is higher unemployment. The second is slow economic growth. And the third is high inflation. So this creates a challenging environment for policymakers as the typical measures to combat one of these issues often exacerbate the others. Now we will dive deeper into those three factors or those three economic trends which lead towards the stagflation. The first is high unemployment. High unemployment refers to a significant portion of the labor force being without work. In a stagflationary period, businesses struggle with rising costs due to inflation, which often leads them to reduce their workforce to maintain profitability. Additionally, slow economic growth implies fewer new jobs are being created, further exacerbating the unemployment levels. Let's take example of stagflation here. During the 1970s oil crisis, many countries experienced stagflation. Rising oil prices increased production costs for businesses, leading to layoffs and higher unemployment rates. Now let's discuss about the slow economic growth. Slow economic growth indicates that the economy is not expanding at a healthy rate. Gross domestic product, known as GDP, growth slows down. In severe cases, it may even contract. Economic stagnation can result from decreased consumer spending, lower business investment, and a general reduction in economic activity. For example, in a stagflation scenario, consumers face higher prices for everyday goods and services due to inflation. This reduces their purchasing power and leads to decreased consumer spend, which is a significant component of economic growth. Now, we will discuss about the third factor of stagflation, which is high inflation. High inflation occurs when prices for goods and services rise rapidly. We have already discussed about the inflation, the types of inflation in the previous lectures and about the high inflation as well. So now we are elaborating it further. This can be driven by various factors such as supply chain disruptions, increased production costs, or excessive monetary expansion. In stagflation, high inflation persists despite the presence of high unemployment and slow growth, making it a particularly perplexing issue for economists. Let's take example here. During the same 1970s period, the sharp increase in oil prices led to higher transportation and production costs, which translated into higher prices for consumers across various sectors, fueling inflation. So now we are elaborating this example further, the 1970s stagflation. Let's have a look towards it. The 1970s are often cited as a textbook example of stagflation. The oil embargo of 1973 led to skyrocketing oil prices, which increased costs across the economy. Central banks initially responded by tightening monetary policy to combat inflation, but this further stifled economic growth and exacerbated unemployment. The situation required innovative policy responses, including a mix of supply side reforms and demand management policies to eventually stabilize the economy. So, stagflation is a complex and challenging economic condition that defies traditional economic theories and policies. It requires a nuanced understanding of the interplay between inflation, unemployment, and economic growth. Addressing stagflation effectively often requires innovative and sometimes unconventional policy measures to balance these conflicting economic forces. Now we are moving towards the causes of stagflation. The first is supply shock. A supply shock refers to an unexpected event that suddenly increases or decreases the supply of a commodity or service, which in turn affects prices. When there is a negative supply shock, such as a sudden rise in oil prices, as we have discussed about this example in the previous slide, it can lead to higher production costs across various sectors of the economy. So here again, Back to the example of oil crisis. The 1973 oil crisis is a classic example of a supply shock causing stagflation. The Organization of Arab Petroleum Exporting Countries, commonly known as OPEC, proclaimed an oil embargo, leading to a significant reduction in oil supply. This caused oil prices to quadruple, sharply increasing production costs for businesses dependent on oil. The higher cost were passed on to consumers in the form of increased prices for goods and services, contributing to inflation. At the same time, the higher cost led to reduced production and investment, resulting in economic stagnation and increased unemployment. The second cause of stagflation is inadequate economic policy. Poorly designed or mismanaged economic policies can contribute to stagflation. These policies can either be fiscal, related to government spending and taxation, or monetary. Monetary means related to the money supply and interest rates. When economic policies fail to address inflation and unemployment effectively, they can exacerbate the problem. For example, if a government increases spending significantly without corresponding tax revenue, it can lead to higher deficits and increased money supply, fueling inflation. Conversely, if a central bank raises interest rates to combat inflation, it can reduce investment and consumer spending, leading to slower economic growth and higher unemployment. During the 1970s, some countries faced stagflation partially due to the inadequate response of their economic policies to the supply shock and inflationary pressures. The third cause of stagflation is structural problems. Long-term structural issues within an economy can also lead to stagflation. These problems might include declining productivity, outdated industrial processes, rigid labor markets, or inefficiencies in the economy. Structural problems can reduce the economy's potential growth rate and make it more susceptible to inflationary pressures. Let's take example here. So suppose an economy with outdated technology and inefficient production processes may struggle to compete globally, leading to lower economic growth. Additionally, if the labor market is rigid with stringent unemployment laws and high wages. With stringent employment laws and high wages, it can limit the ability of businesses to adjust to economic changes. These structural issues can create an environment where inflation persists due to rising costs, while economic growth remains sluggish and unemployment stays high. So, after looking at the three causes of stagflation, we can summarize it as the causes of stagflation are multifaceted and often interrelated. A supply shock can trigger higher production costs and inflation, while inadequate economic policies can fail to address these issues effectively and efficiently, and a structural problem can exacerbate the situation. Understanding these causes helps policymakers design better strategies to prevent and mitigate stagflation. Balancing the need to control inflation, stimulate growth, and reduce unemployment. So now we will move toward the impacts of stagflation. So there are three impacts of stagflation we will discuss in this slide. The first is reduced consumer confidence. Stagflation leads to a decline in consumer confidence, which is a measure of how optimistic consumers feel about the economy and their financial situation. When consumers face rising prices, which means inflation, and increasing unemployment, they become more cautious with their spending. The uncertainty about future economic conditions further dampens their confidence. We'll take an example here. So, suppose during a period of stagflation, consumers may delay or cut back on major purchases like cars, appliances, or vacations. Instead, they might choose to save more or pay down debt. This reduction in consumer spending can further slow down economic growth as consumer expenditure is a significant component of GDP. The decline in consumer confidence can create a vicious cycle where reduced spending leads to lower business revenues, higher unemployment, and continued economic stagnation. The second impact is increased cost of living. High inflation during stagflation raises the cost of living as prices of goods and services increases. This erodes the purchasing power of consumers, meaning they can buy less with the same amount of money. In case of households, particularly those with fixed or lower income, this can lead to financial strain as they struggle to afford necessities like food, housing, and healthcare. So let's take an example here. Suppose if inflation is high, the price of everyday items like groceries, gasoline, and utilities can rise significantly. A family that previously spent thousand a month on groceries might find their grocery bill increasing to 1500 or more, even though their income has not increased correspondingly. This higher cost of living can force households to cut back on discretionary spending, contributing to economic stagnation and further compounding the impact of stagflation. The third impact of stagflation is challenges for policymakers. Stagflation presents a unique and difficult challenge for policymakers as the usual tools for managing the economy can have counterproductive effects. Typically, to combat inflation, central banks might raise interest rates, which can help reducing spending and slow inflation. However, in a stagflation scenario, higher interest rates can also slow economic growth and increase unemployment further. Let's take an example. Suppose the central bank raises interest rates to control inflation. While this may help reduce inflationary pressures, it can also lead to higher borrowing costs for businesses and consumers. Businesses may cut back on investments and hiring, while consumers may reduce spending on big ticket items that often require financing, such as homes, cars. This can exacerbate economic stagnation and unemployment. Conversely, if policymakers focus on stimulating economic growth by lowering interest rates or increasing government spending, it can fuel inflation, worsening the cost of living crisis. So, here, if we summarize the impacts of stagflation impacts are widespread and deeply challenging for both consumers and policymakers. Reduced consumer confidence leads to decreased spending and economic stagnation, while an increased cost of living erodes purchasing power and financial security for households. For policymakers, the dilemma lies in finding a balance between controlling inflation and stimulating economic growth without exacerbating unemployment. Addressing stagflation requires innovative and carefully balanced policies that can simultaneously tackle inflation, support economic growth, and reduce unemployment. Now we are moving towards our next topic, which is devaluation. Devaluation, in the context of international economies, refers to the deliberate downward adjustment of a country's currency value relative to another currency, groups of currency, or standard. This is typically enacted by a country's government or central bank and is distinct from depreciation, which is natural decline in currency value due to market forces. Now, let's understand devaluation with deeper aspects. Devaluation is often employed as a tool to address economic imbalances, especially in countries experiencing trade deficits, where the value of imports significantly exceeds that of exports. By making a country's exports cheaper and more competitive on the global market, devaluation can boost export volumes and reduce trade deficits. Simultaneously, it makes imports more expensive, encouraging consumers to buy domestic goods and services. Now, let's see the downsides of devaluation. While devaluation can offer short term economic relief, it carries several significant downsides that can have long term adverse effects on the economy. Let's have a focus on those effects. The first is reduced productivity of domestic industries. One major downside of devaluation is the potential for domestic industries to become less productive. When a currency is devalued, domestic products become cheaper for foreign buyers, which can lead to a temporary boost in demand for those goods. However, this artificial competitiveness can reduce the pressure on domestic markets or industries to innovate and improve efficiency. In the long term, this can lead to stagnation where industries rely on a weak currency rather than improving their productivity and competitiveness through innovation and efficiency gains. The second downside of devaluation is higher cost of imports. A direct consequence of devaluation is higher cost of imports. When a country's currency loses its value, it costs more to purchase goods and services from abroad. For countries that rely heavily on imported goods, this can lead to a significant increases in the overall price level of goods and services. For instance, or for example, if a country imports a large proportion of its raw materials, machineries, and consumer goods, a devalued currency means that all these items become more expensive, which can contribute to inflation. And inflationary pressure. T-value can lead to different form of inflation, which can further complicate economic stability. So the downsides of devaluation to cause inflationary pressure causes the cost pull inflation, cost push inflation as well. First, we'll discuss about the cost push inflation. It occurs when the increased cost of imported goods and services drives up overall prices. For example, if a country imports oil and its currency is devalued, the price of oil in the domestic currency will increase. This in turn raises transportation and production cost for various goods and services, leading to higher prices for consumers. This type of inflation can be particularly challenging to manage as it is driven by external forces and can erode the purchasing power of consumers. Now, let's dive into the demand pull inflation. We have already discussed it in the previous lecture. Now, I am summarizing it here. Demand pull inflation arises when increased demand for goods and services outstrip supply, driving prices higher. Devaluation can contribute to demand pull inflation in several ways. First, by making export cheaper, it can boost demand for domestic goods from foreign buyers. Second, if consumers switch from expensive imports to cheaper domestic alternatives, this increased demand can push prices up. While some inflation can be beneficial by encouraging spending and investment, excessive demand pull inflation can lead to overheating in the economy where demand grows unsustainably fast relative to supply. Now we will see the downside of devaluation, which is its impact on debt. Devaluation can also negatively impact a country's debt situation, particularly if it has significant foreign denominated debt. When a currency is devalued, the relative cost of servicing and repaying foreign denominated debt increases. For example, if a country has borrowed in US dollars and its own currency loses value, it will need to spend more of its devalued currency to meet its debt obligations. This can strain public finances and potentially lead to a debt crisis if the country is unable to manage its debt burden. The another downside of devaluation is erosion of consumer confidence. Devaluation can erode consumer confidence as it often signals underlying economic problems. If consumers perceive that their country's currency is weakening, they may lose confidence in the economic stability and future prospects of the country. This can lead to reduced consumer spending and investment, further slowing economic growth. Additionally, the anticipation of rising prices due to inflation can lead consumers to change their spending and saving habits, which can destabilize the economy further. The another factor is retaliation and trade wars. Countries that devalue their currency to gain a competitive edge in international trade risk triggering retaliatory measures from their trading partners. Other countries might view devaluation as an unfair trade practice and respond by devaluing their own currencies, imposing tariffs, or taking other protective measures. This can lead to trade wars, which can disrupt global trade, reduce economic growth, and increase uncertainty in international markets. The negative effects of such conflicts can outweigh the temporary benefits gained from devaluation. Now we will see some historic example or the case studies of devaluation. So the first is the United Kingdom in 1967. In 1967, the United Kingdom devalued the pound sterling by 14.3% to address a persistent trade deficit and strengthen its export sector. While the devaluation did lead to an initial boost in export, it also resulted in significant inflationary pressures and increased the cost of imports, leading to higher cost of living. The long-term effect included economic instability and a need for future economic reforms. The another historical example of devaluation is the Asian financial crisis of 1997. During an Asian financial crisis of 1997, several countries, including Thailand, Indonesia, South Korea, experienced sharp devaluation of their currencies. These devaluations were partially driven by speculative attacks and were intended to restore competitiveness. However, the immediate effects were severe economic contractions, soaring inflation, and significant social and political turmoil. The crisis highlighted the risk of rapid devaluation in the context of highly leveraged economies and fragile financial systems.